Markets have a habit of delivering very varied returns over cycles. Advising investors to choose appropriate, correctly risk profile investments to stay in the game is important. And Mike Esmet, Chief Executive of NFB Financial Services Group, joins us now for some strategic thinking. Hey, Mike. Alec dared me to do that.
It's a pleasure, Mark. Lovely to have you here.
Well, just touching on strategic thinking.
You didn't get it right.
I didn't.
No, you got it.
So I need to pause.
Pause. Think. Finger.
Okay.
And then we'll get the best out of
It
it.
sounds like a modeling lesson. Alec, hey, pause, think,
Wow,
finger.
what can I say? We're strategic thinking today.
Strategic thinking. Well, in fact, you see, I'm losing my teeth now. I say strategic thinking. Strategic thinking. But Mike, getting into the details here, it sounds as though, judging by the numbers that you've managed to gather over the last year, that foreign equity has been the place to be, because that's seen a boom of around a 35% increase over the last year.
Yeah, Gugu, that's interesting because not only is it the underlying investments, but you're taking a currency view as well. So we've had a tremendously interesting decade where the rand has been, I think, extraordinarily strong for a couple of very good reasons. Demand for the resources that we export in the form of timber, produce, minerals, and all sorts. And the South African markets delivered great returns. And it almost became a sort of the infradig to go over the water because you're making a mistake. What you are doing is you're taking a double-edged risk. You're taking currency risk and underlying market risk. Whilst if you were in the JSE, you'd be in our shares, who also have an exposure to international earnings and the like, and therefore currency, but it's dilute. So it has given us a fantastic return in the financial year to date of 35.5%, almost 36%. And has eclipsed South African equities, which haven't had a bad run themselves, last day or so excluded. There's lots of volatility there, and we towards the higher end, record end of our markets price earnings multiples, so they are expensive and definitely still remain so on a relative to overseas basis.
You mentioned the word volatility there, and that's one thing that we know for sure that occurs on the markets. And is it sustainable? Because there's all this talk about tapering. We're probably tapered out by now, but once that kicks in, what impact could we see?
Well, tapering is an adrenaline injection. It's kind of the market, the regulator, and the central bank and the states particularly saying we're going to tap money, we're going to tap paper out the market, we're going to leave the cash in the market and make it look for other things. Now, if those other things happen to be cash, they can earn a half or less than 0.5% in dollars or sterling or euros. They could earn a dividend on a share in a quality company, leading company with growing earnings, and therefore invest in the markets. Now, that's the stuff of bubbles. So you can go and apply your money into those asset classes. If you're doing it for the right reason and you have a long time horizon, smart. If you're doing it for the wrong reasons and you're speculating, desperately dangerous. And again, you've got this globalization and the small village. And, we kind of hear at 5 a.m. what China and Japan have done. Aussie we know of as well. And we sort of able to trade in those markets electronically. So the speed and the responsiveness of the market are scary. Equities are not for sissies. They're for good long-term quality investors that have got a long-term horizon, and probably they're going to deliver exactly what's on the can.
But if you got clever or lucky, and you were able to shift between the different asset classes, you'd really be shooting the lights out. It was interesting. Foreign equities, according to your figures, are up 36% this year.
Yeah.
Last year, property was up 36%. So you're still saying go into foreign equities, even though they've had an enormous run.
Well, that's a currency and a market return, whilst the local property market was earnings, which is in the form of taxable distributions out of listed properties.
But the point being,
36.
The rand wasn't a one. You guys all thought the rand was a one-way bet. You're talking again like the rand was a one-way bet. Maybe it isn't. Maybe we've got quantitative easing. I know I'm a minority of one saying this, but when you have a currency that is not being expanded at the rate that the American currency is being expanded, Economics 101 says to me, supply of something rises, the supply of the other one doesn't rise, well then the price actually waits. But it's almost like the whole market is saying the rand is once again a weak currency, get out of the rand, buy offshore. We did that once before, and we took an awful bath in South Africa.
Yeah, I think you make a very good point. That's not the statement I make. The statement I make is that the market has returned in international equities 36%. If you add currency, and the equity return and the dividends distributions in that stock. It's not to say that the rand is going to continue weakening. I might have a particular personal bias, but from a professional perspective, is what are you doing? Are you taking money overseas to politically hedge yourself against calamity in Africa maybe? Are you overexposed to South Africa or Southern Africa? Then think about overseas. The probability of the company, with the vast amount of savings in those companies' balance sheets, with the dividends and distributions and special distributions that they're doing, and the appetite for investors overseas and consumers overseas getting back on the bandwagon. They've had a tough 5 or 6 years. It allows me to say, if it was a retail business that I was investing in, would I invest in a South African one or a global one? Global one's going to be right up there. It's big, it's chunky, it's got lots of cash in the bank, it can go and acquire, it can be good for the underlying share price and probably for earnings as well.
So presumably you're saying that the trend that we've seen in the last 12 years of the South African economy outperforming the British and the most European, virtually all European economies, and the United States economy, 12 years in a row,
Might reverse.
is going to reverse
Might well do, yeah.
because of quantitative easing.
No, I think markets are cyclical, Alec, and I think that people kind of get onto these things at the last leg. So, because the South African listed property market did so well last year, the guys have jumped in there this year, having heard about it at dinner parties, and they've been disappointed because the yield there is only 7 or 8%, if I remember the numbers correctly, and that if you took the actual return, the cash flow out of the story, you're at naught. So the yield on those property companies was 7 or 8%.
No, I get it. But we've got a rand that has been at 750, 650 actually, 3 years ago. It's now gone to nearly 1050 against the US dollar. By following that trend, aren't you making perhaps the same mistake? We're thinking strategically, aren't we?
Again, strategically, I would be making a decision to invest overseas because I have a loaded base here. I have a company in South Africa, I have my salary here, I've got my share options here, I've got property here. Maybe overseas is attractive because it became desperately unattractive and has been sort of the last go-to place for the last number of years. So if strategically I wanted to diversify, overseas makes sense. The counters and the quality of the counters makes sense. It's a much wider market, so I'm not constrained by say one airline and 5 banks, and the investable universe is so wide. I would probably think about that.
I guess the only problem is, are you going to retire here? If you're going to retire in rands, surely you should be building up your asset base in rands, or are you going to retire overseas? Is that not a question you need to ask yourself when you think about these foreign investments?
I don't think that Swiss investors or French investors or UK investors investing in the American or the Australian or the Chinese or Indonesian or Vietnamese markets are thinking about retiring there. They're diversifying.
But what do they know? What do the Swiss know about the Korean market?
Probably as much as we do.
Well, we don't know a hell of a lot more than certainly the Koreans would know more than we would,
Indeed.
surely.
But I think answering your question directly, I'm not going to be investing in the UK only. And although I might invest there and then retire if I chose to Australia or to the US of A. So living in the currency and saving only in the currency where you think you're going to spend your last days with a bit of silver hair, I don't know that makes that much sense. I think diversification is greater than the place you live.
Mike, just very quickly, in order to avoid Alex's dire situation that he's painting out for us here, does it mean that hedging is the best option?
I think that spreading and diversification is indeed the option. I don't think that, and the use of the word hedge is a tricky one for us in the profession because there are hedge funds and things like that. Going into investments with your eyes wide open, being well advised, talking to people that could be an accountant, an attorney, a trusted friend, someone on television at lunchtime, or a professional in the industry makes a lot of sense. Making sure that their agenda suits you would make a lot of sense. So there's not a single line answer to that.
So no more taking advice from your
costs. Check the costs.
Absolutely.
You know, we got nailed as South Africans during this whole international expansion through massive costs. In the way we've been nailed in many ways through other costs. But if you're going to take money offshore, just be sure that you're not getting taken away there.
Absolutely.
Some advice, Alec, coming from you.
Well, why not? I mean, we're all giving it today, aren't we? We're strategically thinking.
Strategically thinking. But that was Mike Esmond, Chief Executive of NFP Financial Services.